Good day and welcome to the Irish Funds Industry Association webinar for Manager Conference Call. Today's conference is being recorded. At this time, I would like to turn the conference over to Pat Lardiner. Please go ahead, sir.
Thank you, and good morning and good afternoon to our various listeners. We really appreciate you taking the time to dial in with us today. Over the course of the next 40 minutes or so, we hope to do three primary things. One, to give you a little bit of background as to why Ireland has developed into a centre of excellence for cross-border funds. Secondly, to give some consideration to some of the practical issues that managers need to consider as they embark on broadening their strategies out to cross-border distribution. And thirdly, and importantly, some of the legal and regulatory backdrop that exists around funds. And I'm joined today by Annette Stack and Aidan Kelly, who will be providing a lot of that detail. So maybe briefly, for just a couple of moments, I might bring you through a bit of background. For those of you who aren't familiar with Ireland, you may be aware we're an island on the northwest corner of Europe, but importantly, the nature of our economy is one where, while we're not endowed with the natural resources that, for example, you have in Canada, we have had a very, very long history and tradition of excellence in knowledge-based industries. That obviously extends to financial services, but also into other areas, be it technology, software, medical devices, pharmaceuticals. And it has actually meant that innovation that needs to exist to provide services has been at the core not only of those entities operating here, but very importantly in the relationship between the industry and government, who understands very importantly that if we seek our objective, which is to act as a critical gateway to international markets, we must make it easy to do business, we must be very flexible and responsible, and have an innovative approach. You'll probably also be aware that following the difficulties that exist in global financial and economies over the course of the last number of years, that we've had to take some very important and in some cases difficult steps here in Ireland around our own public finances. I think it's very important to state that the actions of the government have been lauded as being very responsible in this regard. And one clear indicator for us is the fact that we've seen very, very strong levels of foreign direct investment. In fact, last year, I believe, was one of the strongest years of foreign direct investment in the last 20. That's important because it shows an impetus and also decisions by companies to physically put shovels in the ground and to make long-term capital commitments and capital investments into the economy. One measure, and it is only one measure, of the progress that has been made in the last number of years is clearly the price at which the Irish government or the Irish sovereign borrows in international capital markets. And the graph at the bottom of just this first slide shows you that the yield on Irish 10-year debt has decreased fairly dramatically and steadily over time. And as recently as the last couple of days, it's actually traded down well below 4% to the 385, 384 mark. So that gives you a little bit of background about Ireland. I think then maybe zoning in a little bit more on the funds industry, and if we move on, the importance of the funds industry to Ireland is thematically, we understood and have seen the importance of the need and the move for individuals to make provision for their retirement and also for aged care. So there is a long-term trend and thematic behind a need that we feel in our own small way that we're helping to meet. Because the industry is ultimately providing and exporting its services, both in terms of supporting you as fund managers based in Canada and also investors internationally, it means that the industry is providing a very important source of export-orientated income, which is not dependent on local demand and it's not correlated to the local economy. That's very important, and it's also very important to the government because that's exactly the type of economic activity that they're trying to stimulate here. And it also means that the needs and the important key success factors for the industry have been very centrally in the mind of government and the authorities for many, many years. Indeed, we were very heartened to have the Minister for Finance here in Ireland at our conference in Dublin back in June, and he actually paid tribute to the fact that notwithstanding some of the economic circumstances that have surrounded our own and indeed other countries, that the funds industry has shown really continuous positive momentum. So that background is important, particularly in terms of our relationship with the authorities here. To try and put some figures and some numbers around it, I think I'd start here on the top and to say We have 915 fund promoters and just a little bit over 430 promoters who domicile funds here. They're our clients. Our job is to make sure that we do everything possible to help connect those fund managers with investors around the world. Because of the trust that's been shown by managers of different stages of development with different strategies and of different sizes, it's actually resulted in excess of 12,000 funds being established here or being serviced here. And you can see the breakdown there that we've got on the left-hand side of the slide, just a little bit over 5,300 Irish domiciled funds and indeed 6,900 non-domiciled funds who are partaking or utilizing the service excellence and expertise that exists here. That in aggregate means that while the slide actually says 2.3 trillion, it's fantastic when events mean that actually that number as of the end of June is actually 2.5 trillion euros in assets under administration. And you can see that the amount of that 1.3, 1.4 trillion is actually domiciled assets. But from an investment manager's perspective, another important key metric here is the fact that funds that are serviced or administered or domiciled here are distributed to over 70 different countries. And clearly, making that connection to capital is a key and critical performance indicator of a jurisdiction. The industry supports 12,000 people, which, linking back to what I said earlier on, is one of the reasons why it is front and center in terms of our understanding and our relationship with government. And the reason why all of the above has happened is that there is a very broad and deep network of expertise, whether it be in terms of legal advisors, accountants, listing brokers, tax advisors, our trustee custodian banks and administration companies. And across that network, which has been operating now for around 23 years, there is a great depth and breadth of expertise. One final little just picture to leave you with is on the next slide where, before I get to that, we might actually just talk to the factors that drove the growth in the industry here in Ireland. Very importantly, there were probably one key factor around this, and that is the ability for there to exist investment product structures that were regulated and could be distributed or passported across markets was a key driver in the development of the jurisdiction here. That was also augmented by the fact that we had growing investment markets for much of the last 20 years, clearly not for all of it. And we saw that occur at a time where there was a globalization of the asset management industry. Something we continue to see, which is investment managers who develop a capability based in a certain part of the world wanting to bring that capability both for commercial growth reasons, for diversification of their business, and they've therefore used these regulated product structures, UCITS, which is 25 years old being the most notable one, to really affect that part of their corporate strategy. For our own part, those macro factors have been augmented by a very consistent belief that having an open, transparent, and regulated approach to the provision of services around funds was critical. And it also meant that, as I link back to what I said earlier on about innovation, that we've also constantly updated the regulatory environment to ensure that our solutions are fit for purpose and timely. So as we move on just to the next slide, this just gives a very, very quick pictorial snapshot of the growth in total assets under administration. And bar 1 year, which was in 2009, we've had 23 years of continuous growth through what's been some very, very tough times for markets. And that shows a continuing commitment and involvement by managers in the jurisdiction here to go and to develop our product. The last point before I actually hand over is just this key point about distribution. And I mean, my colleagues will talk a little bit about the existence of, treaty access and memorandums of understanding, but the distribution reach that we have here, whether it be through UCITS products, which would be well known to some on the call, and increasingly now that we're going to have passportable services through the Alternative Investment Fund Management Directive, means that clearly, having set up the structure, there is broad and wide acceptability of it in most parts of the world. So with that overall introduction, I might just hand over to Annette, who's going to focus on some of the practical considerations for people looking to set up funds here.
Good morning, everybody. My name is Annette Stack, and I work at RBC Investor Services in Ireland. I work with asset managers as they're looking to set up new funds in Ireland. So over the following few slides, I'm going to share with you the feedback that we've received from those managers in terms of why they've chosen to set up funds in Ireland, and also some of the key learnings and considerations that they had during that process. So on why fund managers set up funds in Ireland, essentially the primary reason, as Pat has alluded to, is they're generally managers who have established successful strategies with a strong performance record in their home market, but their avenues for growth are somewhat limited in their domestic market, which we're having discussions with a number of Canadian asset managers who are reaching that point. And essentially they're looking at new avenues for growth on an international basis. And we've seen that UCITS has been established for over 25 years. UCITS is very much the gold standard in terms of international distribution. So the majority of funds that are set up tend to be UCITS because of their proven distribution reach. As Pat has mentioned, they have a passport throughout Europe. Similarly, the leading markets in Asia and Latin America, the regulators in those markets are very familiar with this product. So it has true global reach. And subsequently, with the implementation of the Alternative Investment Funds Managers Directive, non-UCITS funds falling under this directive now also have a passport into Europe, and it also provides greater investor transparency. So that's the primary reason as to why managers set up funds in Ireland. They're really looking for new avenues for growth. In terms of why Ireland has been such a successful centre over the years, it's the breadth and depth of expertise that's available across the full range of service providers, and the approach here is very much a consultative approach, working with asset managers who we understand are moving into this environment for the first time. So really a hand-holding approach and a very united approach across the industry. Another key reason is speed to market. Clearly, a lot of managers who have investors lined up want to ensure that they have certainty in relation to product launch. So there's a very streamlined process in place across the different providers in the industry and with the regulator to ensure that timeframes can be clearly provided to clients so that they can manage investor expectations. And this becomes also important not just in the launch phase of a new UCITS, but subsequently in the launch of new sub-funds, that there's certainty and that investors won't be out of the market. Another key consideration, particularly in the context of the Canadian market, is the similarity of business culture between Ireland and North America. Many Canadian financial institutions have already established a presence in Ireland for many years. Some of those names, which you may not be aware of, are AGF, Bank of Montreal, Scotiabank, Toronto, Dominion, RBC, where I'm part of, all have had a significant presence in Ireland for an extended period of time. And this stems from the similarity in business culture, a similar approach to client service, and also a common law framework in place between both jurisdictions. Another key consideration for Ireland is clearly the geographical positioning. Our time zone positioning allows Ireland to service not just the European markets, but also provide coverage across Asia and Latin America, where many of these funds are distributed. And last but not least, the favourable tax regime that operates in Ireland. There's no tax, Irish tax, on fund income or gains. This is very important in terms of some other jurisdictions have a subscription tax in place, and nowadays even 1 basis point of a tax can be very critical in terms of analysing overall expense ratios, where investors have become very much more sophisticated in terms of understanding what that means in practice. If we move on to the next slide, this is a slide that I just thought in terms of, it's one thing speaking to the scale of what we've seen in terms of growth, but I think this highlights, this information from Lipper really highlights over the last 10 years to 2011 the significant growth that has taken place in cross-border funds. And this, as I say, largely will be driven by UCITS growth, and we've seen an increase from 20 to 45% of overall fund distribution on a cross-border basis versus domestic, and that's continuing an upward trend. And what may also surprise people is that 40% of UCITS sales now take place outside of Europe. Asia would be a key component of this, but increasingly Latin America is also a key area. On the next slide, we'd just like to share with you some of the feedback that asset managers have provided in terms of, what's worked for them when they're setting up new funds, and some learnings from asset managers where perhaps they've struggled with some difficulties. what's critical, what we would say, and I think Pat has emphasised this as well at the outset, is the importance of investing time in the pre-launch stage on researching the distribution requirements in the markets that you're targeting. So where you know you have a very good story to sell to the market, it's important to understand your target investor requirements in that market, because they may somewhat differ from the requirements in your domestic market that you're familiar with. So we would encourage managers to, before you start the launch process, to explore distribution strategies. So there are numerous strategies that we've seen pursued, all of which have been pursued successfully. It's very much a matter of what works for your organisation. So some of the options that are available are to establish an in-market presence. For example, if you're looking at distributing your fund into the UK, you can put your own people on the ground to sell the funds in that market. Form a local alliance with a distribution partner in a particular market, or appoint a marketing agent who can, make introductions for you to investors, set up road shows for your managers, and assist you with a marketing program. Now, what we have seen is some managers have used these different strategies may apply for different markets. And another key point that we've seen that has determined critical success for the long term is to really initially focus the distribution on a limited number of key markets in the early stages. Everyone will be familiar in Europe, culturally there can be differences across markets, similarly in Asia. So it's best to understand and do the research on understanding how your story resonates in a key market, and really focus your attention, target distribution in that market in the early stages to build critical mass, and that helps selling the story into other markets. Another element of feedback that we'd like to share with you is asset managers have found that conducting a business trip to Ireland pre-launch has been very helpful in terms of gaining an overall understanding of the industry, in addition to performing due diligence on the different providers that you want to appoint to the business. So the feedback that we've received is that in terms of the time that's been invested in it, whether people come for 3 or 4 days, they wouldn't have really gained as much information. It would have taken them an awful lot longer to gather the level of information and gain an overall understanding of the business that they would have gained in that concentrated period. And the other point that we would make is to assess that your fund strategy is compliant with the required regulations. So in terms of the strategy that you're implementing, that you're looking to take on an international basis, just understand that that does fit within UCITS regulations, or if it's best suited to non-UCITS regulations falling under AIFMD. Some other considerations in terms of considering setting up a fund would be to assess what the internal resource would be to, provide ongoing support for the funds that you establish. So some of the areas to consider are the investment manager time, the operations team time in terms of oversight and compliance. Now, in terms of compliance, the providers in the industry provide considerable support here in that context, but it's just these are areas just to consider in terms of an ongoing basis, again, using best practice, and those managers that have implemented successful strategies have factored in these time considerations to the overall plan. And speaking of the overall plan, nowadays these business plans, all business plans are being scrutinised in greater detail. So just factor into the process the level of time and sign-off that's required internally in your own organisation to ensure, appropriate sign-off in a timely manner for that business plan. And the final point, just in relation to costs and total expense ratios, it is important to understand your competitor universe in the target markets that you're seeking to attract investors. So as part of that process, gathering information around the expense ratios of other providers can help you really to, reduce costs in the longer term, because that can all frame how you're actually going to structure the fund in the initial circumstances. The next slide speaks to set-up options, and Aidan will speak to these in greater depth, but just to highlight the point that Ireland is a very well-regulated and highly regarded fund domicile, and it offers promoters a range of options for fund set-up. So we have on the left-hand side a self-managed investment company, or known more locally as a SMIC. This is the most common option chosen by fund promoters. And in the context of a SMIC, it's the board of the SMIC that takes responsibility for the running of the company and has full control over the company. This can be a selling point, particularly to institutional investors, as they control the full destiny of the company and also have control over distribution. Another option is to establish a management company. And where we see companies establishing a management company is where they're really using Ireland as a pillar for their international distribution. And we mentioned the fiscal attractiveness of Ireland. Management companies, all profits are taxed at 12.5%. So companies would use this as a tax optimization strategy, where they are setting up international funds that will gather large revenues and profits, and, as I say, utilise the tax benefits of having those taxed at 12.5%. And then a third option that may be considered, really to test the water as a route to market, is for those managers who may not, wish to set up their own structure but want to gain an overall understanding of what the appetite is in the market. An alternative route to market may be to work with an existing management company structure. So there are various options available there, and there are a number of parties in the market who would be happy to talk you through the different options. And then on the next slide, we just have a very high-level view of who the different actors are in the process of fund domiciliation. So for a Canadian asset manager or fund promoter who would be setting up a fund in Ireland, the fund promoter and the investment manager would generally be Canadian. And the management company and the board of directors are a combination of representatives from the fund promoter company, combined with the local regulatory requirements to have 2 Irish resident directors on the board. And I will say there's a pool of skilled labour available who, with very strong industry expertise, who make up that composition of 2 resident directors. And then in terms of the parties who are domiciled in Ireland and who are required to support the fund, the custodian trustee, depending on the type of legal structure that's set up, an administrator, auditors, legal advisors, and a company secretary. So on that note, I'll hand over to Aidan.
Thanks very much, Annette. My name is Aidan Kelly. I work with the Irish law firm Matheson Auditors in their New York office, and in the interest of full disclosure, given our Canadian audience, I am a New York Rangers fan, so take that as it is. Following on from Annette's last slide on the key parties, I guess the first place I'm going to move to is the 2 most prevalent structures used to house your investment fund, should you decide to come to Ireland. And the first is the corporate structure, the variable capital company. And as you'll see, the various parties which appeared on Annette's slide now appear as to how they would fit within that structure. As mentioned previously, the variable capital company, the board of that can itself run the company, so that's why the manager is optional on the lower left of the slide. The custodian, distributor, administrator, investment advisor, should you decide to use one, are all there. And then in the middle is the Canadian-based investment manager, who would be delegated the portfolio management and therefore able to essentially run the investments of the fund from Canada. On the following slide, we have a unit trust structure. And as I said, it's the corporate and unit trust structures are the 2 most prevalent used to house investment funds in Ireland. There are other structures available, however, these are, as I say, by far and away the most prevalent and most used. In a unit trust structure, you must create the entity essentially by the execution of a trust deed between a manager and a trustee. The trustee would be the same entity as the custodian in a corporate structure. The manager can be Irish or non-Irish, but it would essentially, its board would be the board of the fund and run from there. And again, the various other parties, administrator, distributor, fit pretty much like the corporate structure does. In either structure, you can either have them as standalone investment funds or as umbrella investment funds, whereby you have separate pools of assets all run by the one board, different shareholders, segregated liability between them. Or additionally, within a standalone or a sub-fund, you can have various classes which you can differentiate by currency, fee distribution policies or whatnot. So there's a lot of structuring and flexibility there with that. One other point to note, not included on the slides, is that an increasingly used aspect has been the use of a wholly owned subsidiary by either the unit trust or the corporate structure. This is, in Ireland, an entity created under Section 110 of the Tax Consolidation Act. And essentially investments are run through that entity as opposed to the investment fund itself. And the reason being that due to Ireland's extensive double tax treaty network, you can get a reduction on your withholding tax or interest payments. And that's something that we've seen increased uptake on, especially given tax planning and its increasingly important role in investment fund structuring. So with those two structures behind us, you essentially are looking now, given AIFMD, at either a UCITS regulated investment fund under the UCITS regulations and directive, or you're looking at an AIF under the AIFM directive. Starting with UCITS, these are of course undertakings for collective investment in transferable securities, and as Pat mentioned, they're now over 25 years old. They currently account for approximately 998 billion in Ireland, which is almost double that since 2008. As both Annette and Pat mentioned, UCITS are a global brand, a gold standard, sold in the EU, Asia, Africa, the Americas, and indeed, I believe over 70 countries now have Irish funds there. The main challenge, I think, that you'll come across with the UCITS is not necessarily your investment strategy fitting in with it, albeit that it's impossible to talk about liquidity and not in some way link it to your investment strategy. But the biggest challenge that people often have when looking at, for example, taking an existing strategy they may have in Canada or wherever else, is to be able to match the liquidity requirements of a UCITS, which essentially is that you must have twice monthly liquidity. And you cannot have that, the last 2 days of the month. It would have to be separated by a few days. So that is the biggest challenge, as opposed to trying to get, your particular investment strategy to fit within it. One of the main benefits of a UCITS, as mentioned previously, is the EU passport. So essentially, by setting up an Irish fund, you are within 10 days in a very simple registration procedure, getting access to almost 30 countries throughout the EU. So that speaks for itself in terms of distribution, and as Annette has previously mentioned, the way in which you decide to distribute your fund is something you should consider at an early stage. One point also that I'd like to mention in relation to the UCITS is that it's created by EU law, and what I mean by that is that a UCITS, whether established in Ireland, Spain, France, Italy, is essentially the same product. It follows the same investment restrictions, and therefore there are no differences between the two, aside from the fact that we believe Ireland offers unrivaled service in terms of its culture, the fact that we speak the English language, the fact that we have a similar legal system to North America, the fact that it's 1 hour closer. All of these things, although somewhat can seem inconsequential, we hear from everyone who's set up in Ireland, mean a lot to them, and it's something that should be borne in mind when it comes to choosing your domicile. Moving on to the next slide, this deals, I guess, with the assets that you're entitled to or you're eligible to invest in as a UCITS. Now, I don't intend to get into the very nitty-gritty of it. On the left-hand side are basically the highlight banner headline of what you can and can't invest in. So transferable securities, which are essentially any securities which are admitted to an official stock exchange or dealt in a market which is operating regularly, recognised and open to the public in an EU or a non-EU member state. Money market instruments are those which are also dealt in a similar market. Financial derivative instruments, there are exposure limits on that. Deposits, which must be repayable on demand, and then investment in other funds. Ineligible assets are things like gold, property, real estate and commodities, but we can deal with how you may be able to get access to those later on under the AIFMD product. I guess the main investment restriction that people come back to is the 5-10-40 rule, or what's known as the 5-10-40 rule. Impossible to listen to anyone speak about it and understand it. It's something you actually have to write down yourself in front of you to be able to get it. But essentially it means any investment position you hold over 5%, bearing in mind that you can only invest up to 10% in any one, cannot in combination exceed 40%. I'm not going to repeat that because, as I said, you're best write that down and have a look at it. UCITS are progressing all the time. It's continuously evolving. There are further proposals to amend the UCITS regime. We expect it'll be at least 2015 before these are implemented. The bottom line is that they're looking at bringing the UCITS regime closer to the AIFMD regime in terms of depository liability, remuneration, and uniform administrative sanctions. I don't intend to get too much into that. I think it's just clear that what looks like is being the driving force in Europe right now is to try and align both UCITS and AIFMD structures and have them, I guess, regulated in similar fashion, albeit obviously that you can do more, or you have more flexibility in the AIFMD in terms of your investment strategy than you would in a UCITS. Moving along, the alternative product under AIFMD and what's currently known as a QIF but will soon be known as a Qualified Institutional Alternative Investment Fund, or a QAIF. It's essentially non-UCITS, which means few investment and no borrowing limits. It's most frequently used for hedge funds, fund of hedge funds, private equity, real estate feeder structures. Again, I would note that you shouldn't just take it that if you've got a hedge fund that it will only fit within a QIF. It could very well fit within a UCITS. So it's something that you should definitely explore before you make your own mind up. One of the major benefits of the QIF is that it's a 24-hour approval process. So once you have all your documents in place, you don't submit those to the Irish regulator in advance. You essentially get your various service providers to confirm the various queries the central bank would have, and 24 hours after you file your documentation, your fund is up and running. There have been some developments in the QIF product over the last couple of years. The main one, I guess, is that in 2010 the minimum subscription was reduced from €250,000 to €100,000, or its equivalent in another currency. That, I guess, has made the QIF product possibly more available to certain people. Ireland was and continues to be AIFMD ready. One of the main reasons we say that is because Ireland is very much used to the self-managed corporate structure, which Annette mentioned earlier, and there was a slide on it also. Essentially what this means is that in the self-managed structure, the QAIF, or the fund, is both the fund and also the manager. So essentially it gets authorised as a fund and also as a manager, which means that you don't have to have a separate entity to go through the whole authorisation process. Currently, AIFMD, although applicable since July 2013, is a transitional period. What that means for Canadian managers right now is that essentially you've gotten three options if you would like to set up a QAIF. The first is that you can either go about setting up an EU AIFM, wherever that might be. The second is that you set up a self-managed AIF, which is, as I mentioned earlier, is why Ireland considers itself AIFMD ready. And the third is that under the transitional period, because of some I guess inefficiencies in the drafting of the directive, it's not actually possible for a non-EU AIFM to be authorised until 2015. Therefore, the central bank, in a very flexible move, has permitted that if you intend for a non-EU AIFM to take up that role in your fund, you can, for the intervening 2 years between now and 2015, essentially go ahead without complying fully with the directive. So that's certainly something that Canadian managers could look at and will find a lot easier than maybe has been reported already to them. The purpose of AIFMD, I guess, is something that often comes up, and really it's politically motivated. It came about sort of at the end of 2009, the final directive was in 2011. I don't think anyone really in the funds industry necessarily thought it was needed in the way it's been brought about, but however we have it and it's here. It does provide increased investor protection, and I guess the main thing that it does do is it does bring around the idea of the passport. So much like a UCITS, if you have yourself AIFMD authorised, you will now have access to almost 30 countries by creating a single investment fund. So that's about all for me. I think I'll hand you back to Pat to sum up.
Okay, well, thanks very much, Annette, and thanks, Aidan. I mean, our objective, as I said at the start, was one, to give you a bit of an overview of Ireland and why the industry has developed in the way and at the pace that it has. Secondly, some practical considerations. And thirdly, to look at the regulatory background, which is clearly very important given some of the developments that we've seen in recent years. Before we open it up for questions, I mean, a couple of closing remarks from me. Ultimately, our objective as an industry here has been and continues to be to connect fund managers with investors. We've been very lucky and very fortunate, and we've worked very hard to have the trust of a number of different managers of different sizes with a range of strategies. I mean, we didn't get into a lot of the detail, but 40% of the world's hedge funds are administered in Ireland. We have complexity across, short duration liquidity funds, traditional balance funds, a range of alternative funds, as referenced by Aidan and Annette, and clearly the ability to have the dexterity to deal with all of those means that the capability exists to partner managers of every conceivable shape, size, and color. That and our ability to work with those regulated product structures that Aidan and Annette talked about, to deliver it in a way that has high service quality and high service excellence, means that for managers, we understand that the important things in the core parts of your own business are to generate performance and to try and actually achieve capital growth through raising investor capital. By having these frameworks, you are presenting to investors what are recognized, well-respected, understood by regulators, and therefore it does take that part of the discussion off the table and allow you to focus on what is always very valuable and sometimes short time with getting your message across to investors and distributors. We believe that innovation has been very important. I mean, even though we've just spent some time talking about the Alternative Investment Fund Managers Directive, Ireland was the first jurisdiction to put up a regulated hedge fund product with the QIF. And actually thinking ahead like that, the central bank at the moment have had discussion paper just finished on the origination of loans within funds. So you can see that there's a continuation here of trying to make sure that we are fit for purpose, and that purpose is your purposes. So we hope that either directly by coming to IFIA and indeed through the very great range of service providers that we have here, and details of all of those are on our own website, that if you want to get into more specific detail, we'd be delighted to do it. But before we close proceedings, we might just see if there are any questions from those on the line. Thank you.
Thank you. If you would like to ask a question at this time, please press the star or asterisk key followed by the digit 1 on your telephone. Please ensure that the mute function on your telephone is switched off to allow the signal to reach your equipment. Again, please press star 1 to ask a question. We'll pause for just a moment to allow everyone to signal.
Sorry, operator, we've had one online question here, which was someone asking and suggesting good sources of broadly just competitor fund information as they look to distribute and to set up funds. Maybe Annette might deal with that.
Yeah, it's a good question. It's one that's frequently asked. Lipper have provided, they've just recently been taken over and the name of the company escapes me, but Lipper have historically provided expense ratios for funds, and they're probably the most reliable data. But equally, in fund prospecti are public documents, and information in relation to costings are also available in a prospectus. But I would say that Lipper is probably the most. It's actually Monterey is the name of the party that took over Lipper, and as I say, they provide data around TERs.
I mean, I'm assuming something maybe behind the question a little bit here, but one of the things that we've seen very strong growth in here, which again talks about efficiency and scale, is we've seen very, very large growth as well as in alternatives in ETFs, passive products, those types of products that need to be produced within fairly rigorous TER constraints as well. So there is actually a particular sophistication and capability here around those. Again, if there's anything we can provide by way of follow-up, please make contact with any of us afterwards. I might just pass back to the operator in case there are any questions coming through via the phone lines as opposed to online. Do we have any other questions coming through?
There is no question at this time. As a reminder, please press star 1 to ask a question. Thank you.
Well, it's seldom that we've ever been so clear and so well understood. I'm very conscious as well that we don't want to take up too much of your time. What I would say in closing is, hopefully you've got a sense for the commitment and determination of not only the participants in the industry, but I think everyone here in Ireland, to make sure that we provide the best solutions for you as fund managers. If there is anything that we can do to assist you, and I think you can be guaranteed if you want to talk to any of, either whether it be the IFIA or indeed any of our member firms, what you can expect is knowledgeable people who will give you straight answers and try and help you get to a position where you're well informed. And ultimately, if you're well informed and you can execute your business strategy, we have the best chance of successfully partnering with you. And I think with that, we'll bring conclusion or proceedings to a close. And again, just to say thank you very much for taking the time to join us today. And we hope it's not long before we can speak again soon. Thank you.
Thank you. That will conclude today's conference call. Thank you for your participation, ladies and gentlemen. You may now disconnect.